A few words on our Bitcoin strategy. Well, when we started, our stock was $118.29. And we had about $60 a share in cash out of that $118.29. And our choice was, in essence, to decapitalize the company and hope that we could keep the $118 stock price, or perhaps to see it sag. So when we imparted on the Bitcoin strategy, we did it with the expectation that interest rates were going to remain low for a while. And here we are 18 months later, and interest rates are still effectively zero, and 30-year yields are effectively 170 basis points. So, and the Federal Reserve has just acknowledged that perhaps interest rates will increase next year. So I think we made the right decision to embark on the strategy. We can see what's happened throughout. Initially, I'd characterize the strategy as defensive. We felt like our $500 million in capital was going to lose 20 or 25% of its purchasing power a year over the course of the following 4 to 8 years. In time, our strategy went from being defensive to being opportunistic. And then we realized that we could raise money under very favorable terms, and we thought Bitcoin was priced very favorably. And around Q4, when we issued $650 million of convertible debt at 75 basis points, and we bought Bitcoin, we thought that was a really good opportunity for us. And then I think by about Q1, in the February timeframe, when we filed our 10K, we noted that now the company had two strategies, a business intelligence strategy and a Bitcoin strategy. And I would say at that point, we rotated from defensive through opportunistic to strategic. And Bitcoin became a strategy of the company and our macro strategy. And we did that because we developed much more experience, and we realized that we were uniquely positioned as a publicly traded operating company with supportive shareholders and a Bitcoin strategy in order to meet requirements that the market had, and to aid the digital transformation of balance sheets everywhere in the world. So you can see we've methodically moved every quarter to acquire more Bitcoin. We're the first company to do it with an explicit treasury strategy. Then we were the first company to do a Dutch auction and invest the proceeds in Bitcoin. Then we were the first company to do a convertible debt offering and invest proceeds in Bitcoin. In Q1, we did a second convertible debt offering, and it was at a 0% coupon, and we invested in Bitcoin, and I think that was a first. And then in the second quarter, we were the first company to do a senior secured debt offering and invested in Bitcoin. We were also the first publicly traded company to pledge Bitcoin as collateral against a piece of debt, and we thought that that was a unique pioneering event or a milestone in the industry. We followed up with that by putting in place $1 billion shelf registration to issue equity at the market. And I think we went forward and we issued $404 million of that equity in Q3. And in Q4, we issued $501 million more under that shelf registration. That makes us the first company to actually issue the serious amounts, probably the first company to actually file a shelf registration and then use the proceeds to buy Bitcoin, certainly in this size. And that takes us to today. I want to share a few words on our capital structure. We think this is very unique. MicroStrategy is the parent company. MicroStrategy has three pieces of debt. It has an unsecured $1.05 billion convertible note due 2027. And again, there's no security, there's no collateral pledged against that. That is, in essence, a note convertible to equity at about $1,432 a share. We have a $650 million convertible note due 2025 convertible at $398 a share. So that's currently in the money. And that yields 75 basis points. Again, that's unsecured. And then we have a senior secured note. And so we have a $500 million note, which is senior to the other two. And that is secured against effectively all the property of the company, the cash flows of the company. And it is secured against the Bitcoin we hold at the MicroStrategy level. We hold 13,449 Bitcoin at the MicroStrategy level with a cost basis of $509 million. So that's the parent company. We have created a subsidiary called MicroStrategy. MicroStrategy holds 109,029 Bitcoin with an average purchase price of 28,874, cost basis of about $3.15 billion. Now, that Bitcoin is unpledged, unencumbered, which means that it is not collateral against any of the three notes you see at the MicroStrategy level. And that gives us a great degree of freedom with regard to what we might do with the 109,000 Bitcoin in the future. We go to the next slide. This slide illustrates pretty effectively how our Bitcoin holdings are evolving over time. For those of you who know me, you know the plan is to acquire and hold Bitcoin. There's no plan to trade it. We're actually going to keep acquiring Bitcoin. That is the plan. That's the strategy. We started with 38,250 Bitcoin in Q3. You can see how we accreted in Q4 to 70,469. In Q1, we got up to 91,326. Then we adopted our more sophisticated capital structure, and you can see the red bar shows the Bitcoin that's at the MicroStrategy subsidiary, and the dark bar is the MicroStrategy pledged Bitcoin against the senior secured loan. Now, both stacks of Bitcoin have been increasing. The MicroStrategy stacks accreted from 13,005 Bitcoin to 13,449. That's because the cash flows that are generated by the MicroStrategy operating business result in Bitcoin, which stays as collateral against that senior note. And of course, the MicroStrategy has accreted, for the most part, due to capital we've raised through equity issuances under the shelf registration. And that has the effect in a way of deleveraging the balance sheet. We can see the price of Bitcoin throughout this time period, and there is volatility. But although some people run from volatility, we choose not to hedge the volatility. We could hedge the volatility if we so choose to do so, but our view is that the cost of the hedge would be greater than the benefit, and we would rather have all of the alpha, all of the upside on the Bitcoin. We're just a pure long Bitcoin play, and we feel that statistically that will yield the highest ROI if you have a long time horizon. If you had a 1-year time horizon or a 12-week time horizon or a 1-month time horizon, obviously you would probably think more about hedging. But if you're looking out to infinity, and publicly traded companies really need to look for the long term, certainly to a 10-year plus time horizon, then it just makes sense to hold it and let the world evolve the way you expect it to evolve. We can go to the next slide. This table gives you a sense of how our balance sheet has developed. And you can see each of the various components, the equity component, 900 million, the convertible senior notes. You can see when they were issued, when they're due, the terms. You can see the senior secured note. And I've described this in detail, so we can move on to the next slide. MicroStrategy it has many advantages versus a simple Bitcoin ETF or holding Bitcoin or certain other investment vehicles. So oftentimes I get asked, why should I buy MicroStrategy stock instead of just buying a Bitcoin ETF or buying the Bitcoin itself? And so we put together this table to help illustrate the differences between owning MSTR, the equity, versus owning either BTC or owning BTO or owning some other ETF. If a spot ETF should arrive sometime in the future, how should I think about it? And the answer, of course, is every investor has different criteria. They have different charters. They have different limited partner expectations. They have different compliance rules. And if you're that investor with that pool of capital, you have to figure out what your charter allows and what your tax and compliance rules and what your limited partners expect, et cetera. So let's just start with the first value proposition. Is this something an institution could invest in? Is it regulated for institutions? So MicroStrategy is easy for an institution to buy because you can buy us through your prime broker. We trade on the NASDAQ. We've got a long history on the NASDAQ, and we're an operating company. Some institutions, they need to buy operating companies as opposed to a finance company like an ETF, and so we have certain appeal to them. A lot of institutions can't buy the underlying property. They can't buy, they could buy a gold miner, but they couldn't buy the gold. They could buy a Bitcoin operator, but they can't buy the Bitcoin. Maybe you can't buy it because you're an SEC 40 reporting company and the great majority, 90% of your capital has to be invested in securities, not property. Maybe there's a tax concern. Maybe you don't have a relationship with a Bitcoin institutional grade custodian or institutional grade trader. If you don't have that relationship and you're a conservative company, you would probably take a year to vet their auditors, vet their compliance and security routines, be comfortable with them as a counterparty. And it might take you up to 3 years. So sometime between 1 and 3 years are required to put in place a new relationship. Whereas if you got a relationship with Goldman Sachs or Morgan Stanley, you could trade anything on their platform in 60 seconds by picking up the phone. And you wouldn't run afoul of your compliance, accounting, risk control, relationship issues. So MicroStrategy is a nice on-ramp, whereas Bitcoin is not necessarily. ETFs and other crypto exposed corporations and Bitcoin miners that are publicly traded may offer the same benefits. Although, of course, MicroStrategy is publicly traded since 1998. And most of these other instruments are weeks old or months old in the public market. So we're a seasoned security for an institutional investor, and we're a known entity, and that's an advantage. I think the second differentiator for us is we offer a non-Bitcoin business value because we've got an enterprise software company that is profitable, that generates cash flows. And those cash flows can be used to, and are being used to buy Bitcoin. And any leverage we get on those cash flows can also be used to buy Bitcoin. So as we improve our leverage on the cash flows or we generate more cash flows, we buy more Bitcoin. If you just buy a Bitcoin ETF, you can't get that. You're not getting an operating company with cash flows. So it's just a bucket of Bitcoin. And if you're buying the Bitcoin itself, it's the same issue. So with MicroStrategy, you can expect that we will acquire more Bitcoin over time, whereas Bitcoin and a Bitcoin ETF is just you're getting exactly that amount of Bitcoin over time in a property instrument or a security instrument. Crypto exposed corporates may buy more Bitcoin. No one has adopted a Bitcoin treasury reserve strategy where an explicit expectation of sweeping cash flows into Bitcoin like we have. So there's a lot of uncertainty with regard to how much more Bitcoin you'll get if you invest in another crypto exposed company. And Bitcoin miners are continually generating Bitcoin to the extent that they're explicit about holding their Bitcoin. Well, then you can expect more. But on the other hand, none of them have, or a few of them have the same ability to generate Bitcoin from non-Bitcoin businesses. So we're uncorrelated to Bitcoin in that regard, since our Bitcoin acquisition is also coming from enterprise software cash flows and enterprise software revenues. And that's an advantage that we have over another Bitcoin miner. If you look at the third column, we can borrow competitively. If you buy 100 Bitcoin on an exchange, well, you don't really have that same ability to issue publicly traded debt or convertible debt to buy Bitcoin. So you're not really getting that access to the competitive fixed income markets if you just own the Bitcoin property. If you buy Bitcoin through the ETF, an ETF management team can't lever up their ETF with long dated fixed income bonds. They couldn't do a convertible bond offering on an ETF. They couldn't really do the kind of senior secured debt offering that we did in June, just because they're just there to hold Bitcoin. They might be able to generate some leverage through short-term futures contracts, but those are really expensive cost of capital. And so far, no levered Bitcoin ETF has been approved. I think there was one where someone applied and it was rejected by the SEC. So it's hard to get leverage through an ETF. And if you got it, you wouldn't get competitive long-term leverage. The crypto exposed corporates, none of them have adopted a leverage long Bitcoin strategy. Bitcoin miners, well, in theory, they could over time. Marathon has done one convertible debt offering. None of the other Bitcoin miners have done convertible debt offerings like us. So we will see what happens there. I'm hopeful that we'll actually see, and I'm optimistic that we'll see Bitcoin miners in time start to issue competitive equity and or convertible debt and senior debt, but they don't have the 22-year track record as a publicly traded company and the long track record in a non-correlated business like enterprise software. So it'll be a little bit more challenging for them, and we still have yet to see how that will evolve. So that's a nice differentiator for us. In essence, we are a synthetic Bitcoin miner, and we can tap into the fixed income markets and the debt markets to aggressively mine Bitcoin through synthetic debt instruments and equity instruments. If we look at the fourth column, healthy operating business. Well, I kind of talked about this in the second, but the key point here is we can sweep our excess cash flows to buy Bitcoin from an uncorrelated operating company. And this is an advantage over just buying the Bitcoin itself or just buying the ETF. And I guess I would distinguish it from column two. Column two is really basically downside protection, because we have intellectual property, an enterprise software company that has a liquidation value, because we have domains like Emma and Usher and Wisdom and Hope, because we have business intelligence software that's valued by our thousands of customers. We provide downside protection to the investor that is uncorrelated to Bitcoin itself. Now, the fifth column is an interesting one that isn't really well appreciated. One of the objectives of an institutional investor would be to see you generate yield from your assets. And as you see, we have more than 100,000 Bitcoin at the MicroStrategy level. So on any given day, we can have $5 billion or more of assets that are not pledged as collateral, that are currently not generating yield. If those assets were sitting in an ETF, you wouldn't be able to generate yield with them, because if they're sitting there, you just have to stare at them. So a Bitcoin ETF is kind of dead money in that way. And if those assets are sitting just as Bitcoin on an exchange, it's the same thing. They're just sitting there as property, but it's not rental income property. So the real beauty of property rights is you could rent the property, you could develop the property, you could mortgage the property, you could put a lien on the property. Everybody understands that with a building. If I had $5 billion worth of commercial real estate and I said there's no mortgage against it and there's no one paying to lease it right now, and it's $5 billion of parking lots in New York City, but we think that we can build a 100-story building on it And if we don't build a 100-story building on it, we think we can sell the air rights above the parking lots for hundreds of millions of dollars to our neighbor. You can see that's a much more exciting value proposition if you can exercise those property rights than if you're just going to hold the $5 billion worth of property and do nothing with it. The Bitcoin itself is just setting its property. The ETF, they've just got to hold the property. Crypto exposed corporates might end up with some Bitcoin, but because they're not focused on Bitcoin as a strategy, they're not really thinking about the liens, the partnerships, the yield, the leverage that they could get off of the property, right? And then the Bitcoin miners, they've got a Bitcoin mining business to focus upon, and that kind of that takes up their time. So MicroStrategy is kind of 2 to 3 years ahead of everybody else in this space in terms of sophistication and thinking about how we're going to generate yield and actively manage our Bitcoin. Now, we have not taken any formal step here yet. And when we do, of course, we'll announce it and you'll be reading about it. But I think we're very enthusiastic about the opportunities to generate yield off of our Bitcoin. We think that the future, there may be opportunities to either put a mortgage against it and generate long-term debt under favorable circumstances, which we could leverage up against the Bitcoin. Or we think that we could lend it to a trustworthy counterparty. And when we find the counterparty that we trust and the circumstance we trust, we might lend it out and generate yield. Or the third possibility would be to put it into some kind of partnership. You know, you could think of that as putting a lien on it. And if we did a partnership with a big tech company or a big bank or some other player that really wanted that access to that Bitcoin, that could become a good source of income for us. Or we could develop it with some kind of interesting application. And you know, I've described Bitcoin as digital property before. You know, you think about it as it's the ideal property to build the digital economy of the 21st century on. There's a lot of things people will build on top of it, right? The Lightning Network will be based upon Bitcoin. There are all sorts of interesting products, insurance products, mutual fund products, et cetera, that could be enhanced with Bitcoin. We will look for those opportunities to actively manage our Bitcoin. And this ability to actively manage, this is what differentiates a operating company from just a finance company. An ETF can't actively manage their Bitcoin. We could, in theory, for example, sell volatility against the Bitcoin. We don't choose to do so because we don't like the cost benefit trade-offs of it, but we could decide to sell out of the money calls, right? Or puts or some other kind of derivative trading strategy, which would generate substantial amounts of near period income in Bitcoin or the like. So these are the things that distinguish MicroStrategy as an investment vehicle versus just buying Bitcoin as property or buying an ETF or buying another company that owns some Bitcoin or buying a Bitcoin miner. I think the last point I'll make is that our Bitcoin position is scale, right? So if you have $6 billion worth of Bitcoin on your balance sheet and your market cap is some multiple of that, but less than 2x, right? Our market cap is somewhat more than 6 billion, but it's not 10x more or 100x more. So Bitcoin on our balance sheet is more meaningful than Bitcoin on Tesla's balance sheet or even Square's balance sheet. And if what you're wanting is Bitcoin exposure at scale, you know, from a leveraged operator that's going to actively manage it, then we think we represent a differentiated vehicle for that. And that will be appealing to the public investor that's looking for a way to get Bitcoin exposure in an intelligent fashion. We can go to the next slide. We think it's still early. How early? Look, Bitcoin's $900 billion in market cap, just slightly less than $1 trillion right now. And it is digital property. So as digital property, for those of you who follow me, you know that digital property is much lower maintenance cost than real property. It's a lot easier to own $5 billion of Bitcoin than $5 billion of commercial real estate. It's a lot easier to own it than 5 billion of gold or 5 billion in silver or 5 billion in equity. So, so digital property is advantageous versus analog property. It's also easier to generate yield off of digital property. $5 billion of buildings in Istanbul are impaired by the collapse of the lira. $5 billion worth of buildings in New York are at the mercy of the government of New York State and New York City. And whether you love New York and think it's the greatest city on earth, it's not the greatest city on earth every minute of the day for the next decade. There will be certain minutes and certain periods where you would wish that that building was sitting in Tokyo or London or Paris, or it was put to a different use. So Bitcoin as digital property is much more flexible. It's high speed. I can move it anywhere on earth. I can move it rapidly at a higher frequency. And that's why we think that gradually digital property is going to demonetize, or at least it's going to grab capital flows from 20th century analog property. So the obvious candidates are sell your silver or monetary silver to buy Bitcoin, sell your gold to buy Bitcoin. And of course, if people start to sell gold to buy Bitcoin, we could see Bitcoin grow by an order of magnitude. Gold is $11 trillion asset class. Another very popular property for store of value for institutional investors is just the S&P index. So if you're thinking about buying the index of US stocks, you might think I'd rather buy an index of the global crypto economy or the global property economy a la Bitcoin. Now, you might want to have global exposure through equities. There's $120 trillion worth of global equities, but equities are partial currency derivatives. So when the Argentine peso or the Turkish lira crash, equities that have exposure that sell things in Argentina and Turkey, they see their value of the cash flows also deteriorate. In fact, the value of the cash flows of every company is deteriorating since the US dollar is losing purchasing power, and just about every other currency in the world is losing purchasing power faster. So to the extent that a currency is, to the extent that an equity is a partial currency derivative, then it makes sense that in an inflationary environment, investors are going to reallocate capital from equities to Bitcoin because Bitcoin's the dominant digital property. Now, of course, the two big bars are global debt, $300 trillion worth of credit. And of course, you know, would you like to have a bunch of international credit right now that's paying off in currencies that are weaker than the dollar, that's got a negative real yield? There's trillions, 17 trillion dollars of negative real yielding debt if you just use official numbers, but I would suspect the number is going to be 30, 40, 50 trillion dollars of negative yielding debt floating around out there. And so we see that flow, that capital will flow into a stronger property like Bitcoin. And then the global real estate market is in excess of $325 trillion. And so it's just very early. If Bitcoin simply grabs 5% of these other property asset classes, then it's going to grow by an order of magnitude or more. And of course, we're very bullish on it because everything you can achieve with a diversified portfolio of real estate or a diversified portfolio of credit or a diversified portfolio of equity can be achieved with Bitcoin, which is in essence a diversified portfolio of monetary asset. It is basically plugging into the entire 21st century crypto economy, which is growing at a rapid rate. Shall we go to the next slide? So institutional investors are becoming increasingly interested in Bitcoin. There are bears, there are bulls. A year ago, we didn't see that much sentiment expressed in favor of Bitcoin. It was a bit unique, but today Citibank is saying that Bitcoin could surpass $300,000 per coin. JP Morgan has begun to cover Bitcoin. Fidelity is covering Bitcoin. Kathy Wood of ARK Investment is very bullish on Bitcoin. Now, some people are not bullish on Bitcoin. Warren Buffett, Nicholas Taleb, not bullish on Bitcoin. We understand it's a controversial business. On the other hand, Warren Buffett never bought Microsoft stock, and he was best friends with Bill Gates for nearly a generation. So just because successful investors don't embrace Bitcoin doesn't mean that it's not going to grow. Microsoft's been quite successful, even without a Berkshire Hathaway investment. And we think Bitcoin will be very successful based upon just institutional awareness. Even if we get to the point where 5% of institutional investors start to take this seriously, it's going to be extraordinarily successful. Next slide. There have been a lot of key developments in the digital assets landscape over the past 6 months. Some that have taken place in the last 12 weeks that are worth highlighting. I saw a memo just a couple of days ago that suggested that the FASB, Financial Accounting Standards Board, is going to take up the accounting of digital exchange traded assets as a research matter formally. So I thought that was a big success. That's exciting. If the accounting evolves from indefinite and intangible, that'll be bullish. And the fact that FASB is considering the matter formally today, I think is very bullish. The memos that have come out of the administration, the president's working group memo on stablecoins is very bullish for the digital assets community. Just yesterday, Jerome Powell was asked on his press conference about whether crypto assets represented a threat to the global financial system. He said no. He said they're assets, they're speculative, right? And he left it to the retail investor or to the investor to determine their risk tolerance for it. But I thought it was, there were two very bullish comments made. One, he suggested that there is a demand for stable coins, and if the country issues stable coins backed by an FDIC approved institutions, that adoption could grow dramatically. And so he sees the power of the crypto economy and the power of digital currency in the form of the US dollar on a crypto rail. I think that he also sees the power, he acknowledges the legitimacy of crypto assets. I think we're seeing across the board politicians acknowledge the legitimacy of Bitcoin as the dominant crypto asset and as another alternative store of value property in a world that's increasingly concerned about store of value. We've seen that from the EU, we've seen it from senators, we've seen it from congressmen, we've seen it from the administration. I think in the latest discussion between Gary Gensler and Jay Clayton, the current head of the SEC and the former head of the SEC, they both acknowledged Bitcoin is not a security. They've acknowledged, in essence, that the regulatory agenda of the SEC is going to be to focus on security tokens, to focus upon stable coins, to focus upon DeFi. And as they focus upon these things, the implicit message is Bitcoin is digital property. And if you're acquiring Bitcoin as digital property, you have a clear safe haven, if you will. So I think what we see from the regulators is a green light for FDIC insured banks to begin issuing stable coins, right? And regulators are embracing digital currency in the form of stable coins. And they'd like to see the US dollar spread on that stable coin. I think that's very good for the asset class. I think they've also embraced Satoshi's innovation of a proof of work, decentralized crypto asset network that was created without any initial coin offering, that is truly decentralized, that is global common property. That is Bitcoin. I think that that is a very positive development. I think the embrace of Bitcoin in the United States following the China crackdown has been a very positive development. I think the approval of 3 Bitcoin ETFs, starting with BITO and continuing with the additional ETFs, I think that's been a positive. I mean, in essence, an endorsement of the asset class. I think that if you read the spot denial ETF, the spot ETF denial memo from the SEC, the clear implication is they would like to see crypto exchanges adopt national securities rules, and they acknowledge that this is an asset class that's going to need to be normalized for the protection of the public, and I see that as being very positive for Bitcoin. Ultimately, there's 2 parts of the economy here. There's the crypto economy, which is entrepreneurial, and it revolves around security tokens, DeFi, exchanges, and digital currencies. And there's a lot of regulatory work there to bring that into the public policy framework. And then there's another part of this economy, which is Bitcoin, digital property. And Bitcoin as digital property is an immediate solution for public investors, publicly traded companies, and FDIC banks, right? Not to hold on their balance sheet yet, because we're still waiting for guidance from the FDIC, but we know that the FDIC has taken this up as an issue. We know that the initiatives of FASB, the FDIC, the SEC, the President's Working Group, as well as congressional initiatives, all of these things coming together are going to contribute to a normalized environment, which is going to be good for Bitcoin as an asset class. Until all the regulatory activity around security tokens and DeFi exchanges and digital currencies is resolved, those are all questionable, and they're complex, competitive, and risky areas. That's why we choose not to invest in them, and that's why we think that Bitcoin is the institutional grade treasury reserve asset in the crypto space. In fact, Bitcoin essence is the risk-off asset in the crypto economy. And I think that every single month that goes by, it's becoming clearer to both investors in the crypto economy, and it's also becoming clearer to institutional investors. I think that having said all that, the other incredibly legitimizing trend that we've seen in the past 12 weeks is just the parade of Bitcoin miners coming public and raising capital. I count somewhere between 16 and 20 publicly traded Bitcoin mining companies in the next 3 months. So it's really an extraordinary number, right? When you get to the point where you've got more than a dozen publicly traded Bitcoin miners that are trading on the NASDAQ, the New York Stock Exchange, et cetera, right? Then that's really a seal of approval, I think, for institutional investors. It gives institutional investors a lot of on-ramps to get Bitcoin exposure other than simply buying the Bitcoin itself. I think all the Bitcoin miners are raising capital. Riot raised $600 million in an ATM offering of equity, I think between October 1st and November 15th. Marathon raised $650 million in a successful convertible debt offering. TeraWulf just this week came public on the NASDAQ and raised $200 million in equity and debt instruments, recently. So you're seeing large sums of capital flow into the Bitcoin mining industry. And if you think about it a bit, you realize that if a Bitcoin miner raises $600 million in equity capital, there's only 2 things they can do with it. They can, in essence, not sell Bitcoin, which is the same as buying Bitcoin. That's $600 million of Bitcoin that won't be sold, but rather will be held in a treasury. Or They can buy Bitcoin mining equipment, which is the same as buying Bitcoin in the future, right? They're committing to buying Bitcoin in the future and mining it. Or they can buy the Bitcoin now. And so what we have is a large flow, billions and billions of dollars of capital flowing via publicly traded Bitcoin mining companies into the Bitcoin ecosystem. This is unique. We don't see this with any other crypto asset, right? Bitcoin is the only crypto network that has achieved enough institutional status and reliability that you can see companies come public with the value proposition of mining Bitcoin. I think this is in essence a symbol of the maturity of Bitcoin, the network, and I think it ought to be a source of comfort for an institutional investor going forward. Geopolitically, I think that the network continues to distribute and decentralize, and the China crackdown was a great thing for the asset earlier this year. I think it's pretty clear that Bitcoin has become westernized, but it is really distributed everywhere in the world. And everywhere in the world that Bitcoin exchanges, Bitcoin mining, Bitcoin derivative products spread, that creates more support for Bitcoin. So you can see the Canadian ETFs, the ETF in Australia, the ETFs in Singapore, the Bitcoin miners everywhere in the world, right? All of these are good things. A note on ESG. Sometimes people ask about ESG, how ESG friendly is Bitcoin? Well, I want to make the key point. First of all, Bitcoin is the most cost efficient, the most cost effective industry in the world. If you look at the price to sales multiple of Bitcoin versus every other industry, Bitcoin is like 57 price to sales multiple. That is to say, you put in a dollar, max a dollar, and you get out $57 of value. The S&P index is only 3, and it was only 1.5 18 months ago. So if you allowed that every single dime of Bitcoin mining revenue was used to burn energy, it would still be more efficient than Google or Netflix or any company on earth, right? That's just how efficient Bitcoin is. If you delve a little bit deeper, you find that Bitcoin is getting more technically efficient and more energy efficient at a more rapid rate than any other industry in the world. Bitcoin mining became 42 times more energy efficient in the past 8 years. The BMC survey indicates our forecast is it gets up to 24x more efficient over the next 8 years from an energy point of view. For those of you who study Satoshi's protocol, you know that every 4 years, mining block rewards are cut in half. And since 99%, 98 to 99% of the revenue in the mining business is driven by block rewards, what that means is that the Bitcoin mining revenues are decreasing by 18% a year, or another way to say it is the protocol dictates 18% technology efficiency improvement every year for the foreseeable future, likely for the next 10 to 20 years. If you combine the 18% protocol improvement with the fact that ASICs keep getting more energy efficient, we went from S9s that were like 99 joules per terahash to S19s, which are 29 joules per terahash. When you think about that, that means instead of 99 megawatts per exahash, you use 29 megawatts per exahash. When you crank that in, you realize that in fact you're getting another 18% improvement in energy efficiency every year. That gets you to 36% improvement in energy efficiency overall as the Bitcoin mining network rotates from being energy intensive to being silicon or semiconductor intensive, technology intensive, if you will. And that dynamic is not very well understood, but the conclusion is this is really the most ESG friendly industry in the world. It's incredibly energy efficient. There is no major industry that is more energy efficient. There's no industry that's getting more efficient at a more rapid rate. If you're concerned about society, well, Bitcoin's giving property rights to 8 billion people. It's also making possible light speed payments to 8 billion people. And if you're concerned about governance, It is the only universally acknowledged common property in the entire crypto ecosystem. And in fact, it's the only universally acknowledged crypto property in the world, which makes it safer and better governed, right? And more ethical than just about any other property you can invest in or any other security that you could invest in. So I think we got a really good story there. I guess one last point I'll make is sometimes people say, well, couldn't you do this without energy on a proof of stake network? And I think the answer is you could actually fly in an imaginary car to an imaginary house, and you could be operated upon by an imaginary doctor, and you could take an imaginary vacation, and you could eat imaginary food, and it would all taste fine in the metaverse with no energy. But of course, in the universe, you need a real car, a real plane, a real house, real medical care, and real food, and it takes real energy. So comparing a proof of work network to a proof of stake network is a false equivalence. It's like comparing a hotel chain run by Hilton to the metaverse run by Facebook. They're not the same thing. And of course, if you think about it enough, you realize that in a world where you could spin up, give everybody a castle on Lake Tahoe for no energy, well, then 8 billion people will have a castle on Lake Tahoe. But of course, 10,000 companies will compete to be the one that provides them with the castle on Lake Tahoe. And you're just going to have a very competitive marketing war between Facebook and Twitter and Fortnite and Google and Roblox and every crypto network and 6,000 proof of stake networks. And it's going to be a marketing / competition thing. And I guess the last point that I'll make here for public investors is proof of stake networks are generally deemed as securities by securities attorneys, and any regulator thinking about it, right? And all of the guidance we see coming out of the regulators for the past year are that, if you're actually staking a token for yield, it's probably a security under securities law. So those networks are going to compete with Google and Apple and Facebook and Fortnite. And you can make money in them. You can make money in an online casino. You can make money in a video game. You can make money running